Hello and welcome to this Select 50 Fund Manager interview. I'm happy to say we're joined today by Richard Woolnough, manager of two Select 50 funds, the M&G Optimal Income Fund and the M&G Corporate Bond Fund as well. Richard, welcome along. It's impossible to ask about your funds without referring to their great size, and M&G of course has this long-standing reputation for fixed income management. When it comes to your process and the management of your funds, how does that expertise and that weight of M&G's experience help you?
Well, it helps in a number of ways. Firstly, it's the infrastructure you work in terms of support of the obvious things that help in running a bond portfolio. A strong, experienced team of credit analysts, a strong, experienced dealing desk. And then on top of that, it's the other people that sit with you. And we're very fortunate in that the vast majority of people who work immediately with me, we've been involved in recruiting as we've been a growing part of M&G. And so it's a quality and experience the people around you helps. So specifically, whether over years as we've got larger, then what's helped me is that we have people who specialise in investment grade on banks like Ben Lord. We have people who specialise in high yield like Stefan Isaacs and his team. And we now have a special emerging market individual, Claudia, and she leads that team. So it's having that group of people to bounce ideas off and having that infrastructure to sit within means that you don't have to get into every detail. You can specialise in what you think you're good at, and you recruit other people to specialise in what you think they're good at, and you create a better team than just being sat without that infrastructure.
Sure. And turning to process then, bond buying means, I guess, taking views on the specific company risk, government risks that you're taking, but I guess it also means having views on bigger macro issues, inflation, growth, rates and all the rest of it. How does the balance of those two things sit in your process overall?
I think the process changes over time. You respond to, you play what's in front of you. So if the conditions point it's really important to have an economic view, you have an economic view. If it's really important to focus down on a sector or focus down on a stock, you look in those areas. So it changes over time. The one thing that does always change is there's always this macroeconomic cycle. And within that macroeconomic cycle, there's part of it is studying it and trying to think where it's going from historical or different perspectives. But the other point is the noise. Everybody else is also looking at that area. And when they get too pessimistic about the economic cycle, you're more optimistic, you can add value. And when they're too optimistic and we're too pessimistic, hopefully we can have value as well. So there's that mixture. And bonds are a strange creature, especially corporate bonds, which is my specialist area, is that they have a pulling forces on them. So if you have a weak economy, it means that bond yields fall. The bonds that we own go up in value. Generally speaking, there's a positive thing that happens. But if the economy is too weak, it means the probability of default of companies goes up because it's harder for them to survive, because it's a harder economic environment, and that brings the price of the bond down, because obviously it'll be more risky. So these two things are always vying against each other, and therefore as looking at economics and looking at the cycle, it's important from the interest rate leg, and it's also important from the credit risk leg. It's trying to balance those two is always something we do when looking through individual stocks, market pricing.
And turning to the situation now then, the end of the bull market in bonds has been called for many, many years. What's your view on where we are now in that picture and what happens from here?
I'm generally a value investor, so if you look at have we been long duration across our bond portfolios in the last 5 years, no. We've got towards neutral, so I would sort of concur that there's that interest rate element, there isn't a great deal of value. On the other hand, I think the credit element, I think people are still too pessimistic. They think the next recession is around the corner. I think economic growth going forward will be strong, which means we don't want to have the interest rate risk. We're very happy to harvest the credit risk we're getting paid for taking. So, and different markets are in different places. We are currently in a bear market. Interest rates are higher, as you know, from bank rates and other things in the UK. They are higher than where they were in Europe. In the US, you're getting close to almost arguing, especially at short-term interest rates, they're almost completed their bear market. Their bear market's almost over. So being a bond fund that can look around the world, depending on the mandate we're given, get a chance. Not all bond markets are in the same phase. bit like equity markets have bull and bear markets in different nation states, bond markets have different bull and bear markets in different nation states, different currencies.
Okay, finally then, given where the bond market is and the uncertainties that are there, what's the case for the continuing presence of bonds in a private investor's portfolio? Are they still acting as the diversifier that they always historically have done?
If you're a private investor, you're basically, you're limited. The typical person is limited between cash, bonds and equities, and traditionally that's the level in terms of the risk they take in terms of making those decisions. From both angles, I think the reason that bonds work is that because of bank regulation, banks used to take the credit risk for you. They used to lend long and borrow short. They used to take duration risk and credit risk. And now the regulator's limiting their ability to do that. So that option isn't going to be as attractive as the past, as banks can't run these portfolios that we've not allowed to risk and run the bank. They're a lot more controlled, a lot more regulated than they were. So versus cash, that helps bonds versus cash in terms of a long-term outcome. Market mechanism has changed. The big difference of bonds versus equities is that they are a contract. When we buy a bond, we know what the return's going to be. We know we're going to get paid our money back on a set date and we're going to get a set coupon. There might be some price volatility, but in 5 years' time, that 5-year bond will redeem. You will see these coupons. You've got a certainty of income. And people desire a certainty of income. There might be some price volatility, but you know what your end return's going to be. With equity, it's not the same. You buy an equity, obviously your dividend varies. You don't know what the share price is going to be in 5 years, never mind in 5 days. So it's a very, very volatile type instrument. So I think the bonds have got a place to sit there in that they can compete against cash. They have characteristics different from equities. I think the other thing that investors probably haven't realised, and it's something that has changed over the years, is the bond market when I started 30 years ago was very limited. The equity market was a large market, everybody understood. Cash, everybody understood. What were bonds? Now, as the markets become more sophisticated, from a client, institutional, and a corporate basis, there's a bigger variety of corporate bonds. So one thing that's really good about corporate bonds is you can buy something that's got a very long maturity. You can buy something that's got a very short maturity. You can buy something that's AAA and very safe, or you can buy something that's got the risk characteristics of an equity. So you've got this whole palette to pick from, which is far more dynamic and far more interesting than maybe the palette you can pick from equities, where you're always long of credit risk because you're in a risk instrument, and you're always long of duration because it's a long-dated income stream. By looking at bonds, you can actually do a lot more in the palette that we have than maybe an equity investor can do, and definitely more than a cash investor can do. It's very, very one-dimensional.
Well, Richard, thank you. That's all we have time for, but thanks for coming in. Thank you.
Thank you very much.